Good day, everyone. For this session, we are going to tackle about overview of accounting. So this is part of conceptual framework for accounting standards or CFAS series. And this is the first installment or topic or video. So allow me to show to you certain source. So this is from Milan. This is the source coming from Milan. So I'm using his book for our discussions. Okay. All right. So hopefully it's visible to you now, the screen. So the book is also Conceptual Framework for Accounting Standards coming from Zeus Milan. So shout out to him for this one. By the way, this video is just for educational purposes and we are not infringing any copyright of any author or authors. Okay, so what our objectives is that at the end of the chapter, the learners, you guys, or we should be able to, or we can define accounting. So we're talking here about definition. Then we state the basic purpose. What is really the purpose of accounting? Which means that there are also other purposes. It's just that there's just one basic purpose that is to be discussed here. Then what are the basic concepts applied in accounting? We can explain them. That's second. Number three, state the branches of accounting and the sectors in the practice of accountancy. So most especially those who will be in the profession. And fourth one is we can explain, we can elucidate, we can expound or describe as to the importance of a uniform set of financial reporting standards. Why is it that we should have one set, common set of financial reporting standards for the preparation of reports? So we will also know that later on. Now, these objectives, by the way, this is like the first, like the onset of discussions for conceptual framework and reporting standards or CFAS. So allow me to say that in every chapter or lesson, the learning objectives or outcomes will be the guide, such that at the end, we will be able to know that, oh, we are able to achieve those outcomes because the key here is achieved outcomes. It's not like the intended or intention, it's really the achieved ones. So we can really do them. All right, this one is definition coming from American Association of Accountants or AAA. So this definition is one of those that would stood the test of time. So accounting is considered as a process. If you say process, there are steps involved. So these steps, just like the scientific experiment or steps, would be done in order. So we cannot skip the steps. Otherwise, you wouldn't be able to obtain the desired information. So example of that is if we bake a cake, so there are steps to be followed. Otherwise, you will not be able to achieve the desired output. So we think of the output, begin with the end of mind. That's a cake. So what do we do now to get the cake, right? In this case, in accounting, so our outputs would be the reports. These reports are called financial statements, which we will discuss perhaps here just a tidbit and extensively or exhaustively in this level and the higher accounting subjects. So the process would be identifying, measuring, and communicating. So if you say identifying, we are going to look into the item as to whether that particular item is something that is accountable. So accountable meaning it would have impact to the financial statements. If you have seen already the list of accounting elements, if you have done advanced readings, and for those who are able to already like read and then who work from the ABM in senior high school, so you've known these things. So you have from assets, down to expenses. So these are the accounting elements. If they affect those assets, liabilities, equity, income, and expenses, so the transactions will become accountable. And we just have to remember that not all of them will become accountable. And that is something that we are going to discuss or tackle. Then measuring is we assign values or monetary considerations or amounts to the transactions. And finally, communicating. So in this particular definition, after we measure, we produce the output and we use that output to communicate to various users because these users would be making decisions. So that's why we have here economic information since we talk about amounts or figures, so in pesos, then this is to permit the users of information to make informed judgment and decision. So there's the word here informed on the sense that the decisions by these various users or stakeholders would be dependent upon the information given to them in the form of reports or financial statements. So it's not a matter of personal judgment or opinion, it's professionally made opinion. All right. Okay, so to continue, okay, so I've already discussed to you that there are three important activities on that definition. So only accountable events are recognized. How do we know that again? As what I've said, they would affect the accounting elements. And you will know also later on that the events are accountable if they have two sides, the value received and value parted with. So you will know that also in the future, especially in fundamentals of accounting or basic accounting. So you have the value or the amount or consideration received and the value parted with. So for us to be able to gain something, we should also take away something. That is business perspective. So it's give and take relationship, in other words. And then the analysis will also lead us to determine whether they will be recognized. Because if they're accountable or the events are accountable, we're talking here about business events, by the way, because accounting is for business. So not the personal transactions of the owner of the business or the owners of the business. No, it will be focused on the business itself. So we will recognize if they're accountable events, in other words. Number two, measuring, as what I've said, is assigning amounts or values. In the Philippines, since our currency is Philippine peso, so we expect that the financial statements are to be expressed in Philippine pesos. Number three, communicating. In communicating, so this is again where the reports are now furnished to the various users and stakeholders so that they can make decisions. All right. Now, what are the types of business events in the business? They can be in a form of external or internal. Literally, if you say external, it happens between the business and another business. So the business and an outside party. Okay, so here are some examples. To oppose with internal events happen within the business only. So this is somewhat literal in nature or concept. So when we say external, these can be classified into three. One is exchange. If we say exchange or reciprocal transfer, this happens when one entity gives something, of course, a consideration or an amount or the accounting elements that have financial values to another party, in which one party would give and the other party would receive. So it's a give and take relationship. That's exchange. One example of that is a sale transaction. So let's say seller, the one that gives the goods or delivers the goods, would give the goods to the buyer. The buyer will receive the goods. So that's exchange. And the buyer is, of course, not the entity itself. Otherwise, it's like transferring resources or money from one pocket to another pocket. That's not it. It's the business and another business. I hope that is clear for exchange. Letter B, non-reciprocal transfer. Non-reciprocal transfer is basically a one-way transaction. So in this particular case, for that, a one-way transaction basically means that one entity gives, but the other, for example, just receives it, and then without giving something in exchange or return. So it's one way. One gives without receiving, and one receives without giving. So something like that. It's non-reciprocal. One example is donation. So when entity X or business X would donate money to another company, let's say Y does not exchange something in return, right? Okay, so that is non-reciprocal. Another example could be, let's say, gifts or charitable contributions. So no receipt, or the entity does not receive anything at all because of the giving. Okay, that's opposed to exchange. Letter C, it's other than transfer, whether reciprocal or non-reciprocal, that's A and B, but the cost is outside of the organization. So one example of that would be the calamities. So when calamities would, for example, happen, but then in that particular case, if you say casualty, it's anyway classified under internal event, although the happening is outside. So the point here is that there are changes in economic resources or obligations, but it is caused by an external party or external source. So one example of this would be the changes in fair value and also the price levels. So that's the market dictating that. And another one is obsolescence. So when goods like technological gadgets or items would be obsolete, so they would decrease in the value. So still dictated by the market factors or forces. Then vandalism, when certain people would be putting some graffitis or writings on the company's wall or premises. So those things beyond the control of the organization. All right. So that involves an external party or external source. So if you say fair value changes, so meaning the values of or prices of the products would change in the market. So it is caused by certain parties, meaning the buyers and sellers would be interacting in the market, resulting to established prices. But then if you say casualty, which we'll discuss in internal, it's not a party. The typhoon is not a party or a source external. So it doesn't have a persona, in other words. Okay, so going to number 2, internal events, it does not involve an external party. One of that is production. When we convert our raw materials or the direct materials to be processed, the process is called production, to become finished goods or outputs or products. So this is production. Internal, it happens within the company. But of course, the purchase of raw materials needed to produce the products, if for example, company X buys ingredients to produce bread for the production of bread, so that is exchange. That is exchange because it involves buying the raw materials, and in exchange, we pay for it. Or if it is, for example, on account or credit, we call that utang in Cebuano or Filipino. So in that particular case, it's still going to be exchange. But the production after the purchase or acquisition, that would be internal event. All right. On the other hand, casualty is caused by external event, but it's not really an external event that we know of here. Because we might say, my point is, we might say that, oh, typhoon is an external event, yeah. But the point is, it's not an external party like an entity or source that causes the event to happen. So example would be typhoons, earthquakes, volcanic eruptions, floods, etc. Fire would also be causes of this. So the losses, the negative impact of those casualties will be treated as part of expenses and would of course trigger recognition because the event is accountable. When we say, by the way, recognition, meaning we have to place certain accounts or account titles and the amounts later on. So we call this journalizing process. First step of the accounting process, by which we will know later on, of course, in fundamentals of accounting or basic accounting, or in your other subjects, if you may. All right. Measurement. So in measurement, there are many bases, but the common one is historical cost. From the word historical, it's based on what happened from the past. Since normally the amounts recorded are based on already done or finished transactions. So historical cost is common, but when we prepare our reports, it will be mixture of costs, historical costs, and values. So example of that would be the fair value, which is the value by knowledgeable and willing buyers and sellers and parties in an active market. So there is really a market or mercado in which that particular buying and selling activities would happen. And the prices again established would be made by them. No coercion, no intimidation, no undue force or violence exerted in the process. Number three is present value. So in this particular situation, we can really ask ourselves as to the value of this is 500,000 in the future, let's say 5 years from now. What is its value at the present? Because if that is going to be 5 years from now, the amount today would not be 500,000. That's present value. Realizable value, on the other hand, there's the word realize. In accounting, if we say realize, that means that the asset or any other asset, by the way, is a resource owned by the company. So let's say machine. Machine is sold in cash or let's say on account. So in that case, it is realized through sale. That's the time that we can say that it's realizable. So the amount by which that particular asset can be sold is called realizable value. On the other hand, if it is a liability or an obligation to pay to our creditors, then the value in which we have to pay that particular amount of credit or account will be the settlement value. So the combination of realizable value is settlement value. Then another one is current cost. For example, we acquired machine 10 years ago. For us to acquire the same machine today, like after 10 years, how much would that be? That is current cost. And sometimes inflation adjusted cost. So there are some items in which we have to adjust or incorporate because there are risks involved. One of that is inflation. So in the market. However, let's just be clear that in accounting, normally we disregard inflation. So that's why it's very, very few instances that we have to adjust the cost because of inflation. So one key input there is that if the item is based on market values with interest, because the interest should be able to capture the impact of inflation. So that's why it is sometimes only. All right. And overall, it will be a report composed of these amounts or values. Okay, next. In accounting, it will be combination of fact or opinion or objective or subjective items. So objective if it is fact, meaning whatever is the amount, let's say historical cost, that's it. No estimation. On the other hand, opinion is, of course, subjective based on estimate, but the estimate is done professionally, mind you. So let us remind ourselves that although this is an opinion, but it is not a personal opinion, but professional opinion. So I repeat, estimates is to opinion, and then fact is to non-estimates or not estimates. Okay. Next, what is the basic purpose of accounting? That is to provide information. This information is quantitative, meaning these are expressed in numbers, but specifically, the numbers are expressed in pesos or any other currency if we are living in other countries. And then we say that it's primarily financial in nature. So quantitative information, primarily financial in nature, about economic activities in which you have already tackled the accountable business events, which can be external or internal, intended to be useful in making economic decisions. Because again, the users or stakeholders coming from various areas in an economy would be using these reports to make their wise economic decisions. So informed users then. Okay, so what particular information and reports that we can have and we can provide to our users? So we have two, the general or the special. The general purpose is, of course, when the word general, it would address the common needs of most statement users. If you can notice the wordings here, it's not all of the users because whether we like it or not, no report can address all needs of users. It will just address the needs which are common among the various users of financial statements. I hope that's clear. If it addresses all, very good. But normally the purpose is only the common needs of wide array or range of financial statement users and decision makers. The standard that we are going to use is called PFRSS, the Philippine Financial Reporting Standards, which are solely based and clearly based on the international counterparts, international financial reporting standards based in London, United Kingdom. All right. The second one is special purpose. So as compared to general purpose, the special purpose would be designed to meet the specific needs of the users. So if we want more information not on the general purpose, then we are going to have the special purpose information. But these are now on the other areas of accounting. So these areas like managerial about the management, meaning internal users and tax basis for BIR, Bureau of Internal Revenue for taxes, would be special in nature. And then our concern here in CFAS, Conceptual Framework and Accounting Standards, would be the reports or outputs intended for financial reporting purposes. So this is financial accounting, which is one of those areas in accounting. Okay, what are the concepts that we should know of? So there can be many concepts. This is not an exclusive list, but these are like the common items that we have to know of. So one of that is double entry system, which basically means that in accounting, there are two sides. For us to be able to get something in return, we should be giving also. So it's a give and take relationship, which is a basic concept in economics. That's cost sacrifice. So to get the benefit, sacrifice an amount. And then there are two parts, debit and credit. So basically, debit is the value received. Yeah, so the amount that is obtained in the process, while credit is the amount or value parted with or given. Okay, so that's the double entry system. And then the going concern, on the other hand, which is known as continuity, from the word continuity or continue, meaning the entity will continue for an indefinite period of time. Indefinite, which means that it is not defined, it is not clear as to when would the business would really end. Of course, a business has an end, but our assumption is that we will just continue our operations in the business. So the concern is going concern. Then third is separate entity. In separate entity, this simply means that the entity transactions would be separate from the owners. So separate business transactions from personal transactions of the owner or owners. Separate entity is also known as business entity or accounting entity concept. Next, stable monetary unit. This means that we do not account for changes in purchasing power, that is inflation that we have mentioned a while ago. But yeah, we haven't mentioned anyway inflation, like the definition, but inflation simply means that it is the continuous rising of prices of the basic commodities or the continuous rising of the general level of prices of basic commodities. That's inflation. So in that case, if we have a timeline or a timetable, so we can notice that overall there is really an increase in the price. So inflation can simply be like this situation. Compare the 500 pesos that we have 10 years ago when we buy goods today. So we can just say that we can purchase very less or lesser today. So before, that could be like sacks of items, but now it could just be like one plastic. So that's inflation. However, accounting basic concept is we do not account for changes in inflation. So whatever amount that really was obtained or given or paid in the transaction, then that's it, even if it is from the past. But as said a while ago, there are some situations that we have to account for that. So what about if we use the fair value in the market? That's not the inflation. So fair value is not synonymous to adjusted amounts or costs because of inflation. Those are two different things. I hope that is clear. Next, time period. We all know that again, the business would end, but or the life of business would end somewhere. But we cannot wait as to the time that the business will end for us to know how much really the business earned in the process so that we can now also divide it among the owners or give the share to the owners and the other stakeholders like the creditors because we have to pay them first. So we cannot wait. What do we do is that we divide the life of the business into equal intervals of time. So in time period concept, these periods could be four. Normally, it's annual or every 12 months. That's the first one. The next one would be the so-called interim periods. interim, interim periods, which simply means these are the periods less than 1 year. So we have three: semi-annual or semestral, which means every 6 months. Another one is quarter, which means every 3 months. And another one is monthly, which is of course every month. So there are four: annual, semi-annual, quarter, and month or monthly. So those are the periods. You call them the accounting periods. Time period is also known as the periodicity concept. Okay, that's another concept. Another one is materiality. In accounting, we check if the values or amounts would be material to the point that if we omit that amount or we wrongly place the value or the amount on the financial statements, then the users would be doing other decisions. So meaning their decisions would change because of the omission, so non-inclusion of the information or wrong information. So that's materiality. And then we all know that materiality is a matter of professional judgment also. Then cost benefit, on the other hand, means that the cost must not exceed the benefit. So it must be our overall rule in that case. So cost must be lesser than the benefits. All right, so continuation. You have accrual basis of accounting. In this case, when we record, especially income and expenses, so income would be the earnings that we earned in the process, and the expenses are the values that we pay or we let go to be able to earn. All right. So in accrual basis of accounting, the timing of payment through cash is not important. What is important is for as long as income is already earned, and when does it become earned? Basically, if we already sold our goods or we rendered the services. Because what if we are a service concerned business? So we provide services like massage, like education or teaching. So in that case or in those situations, the basis would be accrual. So we are able to sell or deliver the goods, render the services, so recognize earnings, even if no cash is collected yet. On the other hand, for expenses, for as long as the expenses there are already incurred, they have to be recognized. So one of that would be electricity or the utilities like water, like internet. We have already used them, but the payment will be after the usage. The usage or utilization is already there, which means that there is already an expense to be recognized, but the payment is done later on. And it doesn't matter as to when will be paid or will it be paid. Okay, that's accrual. The opposite of that is cash basis of accounting, in which the basis would be when cash is received or collected and when it is paid or given to certain parties, which is not our basis. It's accrual basis of accounting. Another one is historical cost concept. So the historical cost concept is when the value of the asset is based on the acquisition cost or the value of that particular asset. That's historical cost concept. Another one is concept of articulation. So all the items on the financial statements are connected with each other. Then if we have known the financial statements, most especially those who are done already with this one, we should know that the items, for example, in the income statement are connected to the items in the balance sheet. So the items of income, for example, coming from the sales would be very connected also to the items related to the collections in cash and the receivables, the balances that are not yet collected. So they are interrelated with each other, and that's the concept of articulation. Next one is full disclosure principle. So in accounting, any amount that we think that would affect users should be included. This is in relation to materiality, so that the details to be disclosed will make difference to users. Next, consistency. In consistency, we apply the same concepts from one accounting period, whether that's a year, a month, a semester, or let's say quarter, will be applied from those accounting periods to the next. Although there is somehow an additional information here, which is probably to be tackled, if not later, but let me just mention that it doesn't mean though that we are not consistent anymore should we change our accounting policies or the rules or frameworks in the company. If the management believes that the change would result to more meaningful and useful information, then better change the amounts or values or the accounting information because that would have better benefits. So if we would like to change for the better, then we should apply that, especially if there will be changes in accounting standards. In the accounting landscape, change is prevalent, change is imminent, change is there. So doesn't mean that we change that we are no longer consistent because anyway, consistency can also mean that some accounting principles will be applied same or similarly in accounting periods for as long as they're applicable. But if there is a better alternative, so we use it, and then for as long as it is applicable until such time again that it is to be changed and so on and so forth. So change is imminent. Okay. Another concept is matching. So we connect cost and expenses with the revenue. So we recognize the expenses and cost when the revenue is recognized. That's the point. So there's the revenue. There's already the sale. What are the costs involved to get the revenue? That's matching. Another one would be theories on the accounting equation. Anyway, so if we know basic accounting equation, we already know that assets equal liabilities plus equity. So that's like the basic accounting equation that really stood the test of time, and that's it for all eternity. We can no longer change that. However, in equity, if this is a corporate type of organization, there are two types of shareholders: the preferred, also known as preference, and the ordinary shareholders. The shareholders, by the way, are the owners or investors in a corporation or a corporate type or setting of an organization or business. So what's the difference? Basically, preferred or preference from the word prefer, meaning they are to be prioritized in case there would be earnings of the corporation or in case of when the corporation is to be dissolved or liquidated, meaning the life has already ended or terminated. So we have to recognize the shares of the shareholders after paying all creditors applicable both outside and inside the organization. Then the preferred would be getting also the priority on the net assets or the remaining balance of assets. But the ordinary will get the remaining balance. So that's the difference of the two. To have the residual equity theory, that is simply to get the balance, which is the ordinary, because overall they are the persons or investors who really shouldered the majority of the risks of the organization. So that's why it's residual. Residual from the word residue, which means what remains after. Okay? So I hope that is clear. It's quite a lengthy discussion, so hopefully you're following. Next, fund theory is all about the funds, the resources that are used in the business, so how they are managed. Realization is, this is already said, when we sell the goods to become cash, or claims for cash, which means the receivables, because not all sales would result immediately to payment in cash. Next, prudence or conservatism. So in this case, we have to be careful in making our judgments so that there is inclusion of a degree of caution. We have to be careful about using our professional opinion. Although prudence and conservatism can be synonymous, but some books would differentiate the two. Because prudence is inclusion of caution, but conservatism is with continuation, that assets or income are not overstated and liabilities or expenses are not understated. So in this particular part here, this means that the assets or income should be like lower. If there are alternative choices, we should choose the lower amount. The liabilities or expenses should choose the higher amount. So it's like the concept that we expect no profit but anticipate for all losses. So meaning we are like pessimistic. We are like negative thinker here, that we are going to think of the negative than the positive. So which is why conservatism is like change into prudence. However, majority of the books would say that they're like similar. Anyway, we are not going to debate about that, but just telling you that prudence could be different. Prudence is usually the term in IFRS, but or PFRS, but conservatism is on the part of the US GAAP, which would be the set of accounting standards that we used prior to IFRS. That was before 2005. So 2004 and before, we used the US standards, which used or utilized conservatism concept. Anyway, another one. Okay, we're done with the theories. Next would be the areas. So I've mentioned already financial management and tax. Cost is on the items of the values that we need in order to make or produce the product. So we need the materials. We need also people to help or to do the production process. In addition, aside from these two, there are also additional costs like electricity, like water. So that form part or those form part in the overhead. Next, auditing. So after, for example, financial accounting, we are done with the reports. We have to check if those reports really are in accordance to certain criteria. And we express our professional opinion as auditors. We are auditors here as opposed to accountants. So auditors would be counter checking, or we'd be giving the professional opinion. Government accounting is, this is like one discipline or subject in accounting, in higher accounting subjects, wherein the funds of the government should be, of course, recorded, and then the reports are to be furnished or generated to have emphasis on how the funds are effectively managed, because the funds are entrusted to the government as a whole. That's government accounting. Next, the sectors in the practice of accountancy. So for the soon-to-be accountants or the practitioners, there will be areas by which we can practice the profession. So this may not be applicable to all because others would not pursue or others would not become licensed, but then we can practice in the public accountancy. So this is like auditing firms like SGP and company, although non-accountants, by the way, can also be part of the profession, but they're just not the CPAs that we are talking about. Because for one to become a CPA, one should graduate BS accountancy and one should be able to pass the CPA board examination. That's to summarize. Then practice in commerce and accountancy, this is on the private sectors. Let me go back to that. So education would be universities, colleges. The universities and colleges could be state, meaning government, or it could be private. Could be sectarian, meaning with religious management or religion-oriented management or not. All right, so government is clearly the government. So whoever has a position there will become practitioners in the government. So could be in the government-owned and controlled corporations or GOCCs like Pag-ibig, SSS, and so on. So number two would then be like the catch basin, that any other CPA who is not employed in one auditing firm, in the college or university or in the government, would become practice in commerce and industry. So if you are practitioners or accountants or auditors in the San Miguel Corporation or Ayala, for example, Aboitiz, these are the famous companies like Gokongwe, etc. So that's practice in commerce and industry. All right. Then the standards that we are going to use would be the Philippine Financial Reporting Standards. And there are three sets there: the PFRSS, the PASS, and the interpretations. Take note that these three standards are of same level. So it doesn't mean that because one is PFRS that it has the higher degree or authority of number two and number three. No, they are of equal authorities and they complement each other. They do not compete with each other. All right. Next, the need for reporting standards. So why do we have to have the reporting standards? Because we need to be able to prepare reports. And these reports should be relevant and reliable, useful, meaningful to the needs of our users or decision makers. Otherwise, the reports that we are making will just be a waste, or it's just a paper that will gather dust in the process because it's not basically utilized by us. And then it should be uniform, because how can we be consistent, or how can we compare one entity over the other in the same industry? Let's say in the retail sector, retail of, let's say, apparels, of clothes, etc. How can we compare the performances of them if we have different standards, right? So to establish comparability in the industries, then there should be harmonization of the accounting standards so that it would be easier for us to understand and analyze and make decisions in the process. Then the standards, in order for them to become generally acceptable, so that's why GAAP could be mentioned here somewhere, generally accepted accounting principles, which are the Philippine Financial Reporting Standards. They have been made or established by authoritative accounting rule-making body. So in the US, we have the FRSC, the Financial Reporting Standards Council, which is in charged with the approval of the accounting standards and the issuance dates, compliance dates of them. These standards are again based on the international accounting standards or financial reporting standards made by the International Accounting Standards Board, that is based in United Kingdom, in London particularly. And if the principle has gained general acceptance or acceptance due to practice over time. Example, there's this principle and then it's not yet understood, but this has been used by a lot of practitioners over time, and then it is considered most useful. Hence, they're called generally accepted accounting principles. Okay, just like cost principle, historical cost principle, that's a principle. It has gained acceptance over time. Although there, again, could be some mixture of values. But historical cost has stood the test of time. Then the process of establishing a financial accounting standard or the standards is a democratic process. So everybody, majority of practicing accountants must agree first with a standard before it becomes implemented, right? So everybody would, of course, view it, see it, could comment, but for such to become required or for such to be required to be used and implemented in the preparation of financial reports, then the majority should agree. That's why it is a democratic process. It would undergo some voting, votation, and majority would win, or the rule of majority. All right, so that ends our discussion involving the introduction or overview to accounting. So hopefully you learned something for today, and then we see each other for another session or our lesson, the next topic. Thank you for listening.